As I record this video, NVIDIA's market capitalization has already reached $5 trillion. At that valuation, I had to seriously consider whether it was time to sell. The company is already enormous. How much upside can possibly be left? Tech giants are spending hundreds of billions of dollars on AI. But if those investments fail to earn an adequate return and capital spending eventually begins to fall, how long can NVIDIA's current growth and high gross margins last? Could it become another Cisco after the dot-com bubble, still an excellent business, but one whose share price had priced in too much of the future too soon? That was the question that worried me most as I studied NVIDIA. To answer it, I reviewed public disclosures from NVIDIA, TSMC, its major customers, and its competitors. Based on the framework I use, I estimate NVIDIA's fair value 3 years from now at roughly $8.8 trillion. Of course, that is not a precise number. Nobody knows exactly how fast NVIDIA will grow over the next 3 years. Jensen Huang may not know either. Models, chips, supply chains, capital spending, and the geopolitical environment will all change. The best I can do is use the information available today to reach a conclusion that can be tested later and is convincing enough for me to act on now. My conclusion is clear. I will continue to hold the stock. As long as the fundamentals remain intact, a pullback would be an opportunity to add. Now let me explain how I arrived at $8.8 trillion. I did not build an elaborate valuation model because a model without reliable inputs is meaningless. Forecasting future revenue is inherently subjective. Change the assumptions, and you can make a spreadsheet produce almost any answer you want. So I reduced the problem to the most basic business logic. To estimate NVIDIA's future growth, I only need to answer 2 questions. How large will demand be and how much can supply expand? Let's begin with demand. Demand cannot remain strong simply because large technology companies are willing to spend. In the end, AI has to help them make money. As long as AI continues to raise revenue or lower costs, these capital expenditures are not just cash being burned. They are the purchase price of future growth. The answer is becoming clearer. The value created by AI is moving beyond laboratory benchmarks. It is now showing up in real revenue and measurable conversion gains. Meta is one of the clearest examples. On January 28, 2026, during its fourth quarter 2025 earnings call, Meta said its GEM ad ranking model and a new sequence learning architecture increased ad clicks on Facebook by 3.5%. They also increased conversions on Instagram by more than 1%. A separate real-time inference model lifted Instagram conversions by another 3%. Meta also said that several AI video generation advertising tools had reached a combined annualized revenue run rate of $10 billion. This is no longer hypothetical value. It is showing up in actual revenue. AI is doing more than improving the businesses of existing giants. It is also creating new ones. On March 31, 2026, OpenAI completed a funding round at a post-money valuation of $852 billion. On May 28, 2026, Anthropic completed a round at a post-money valuation of $965 billion. Both companies are approaching the trillion-dollar mark. A new generation of AI-native companies has emerged, and they are competing for users, developers, data, distribution, and most importantly, the next major interface through which people access technology. Every technological revolution creates new species and drives old ones toward extinction. Cars displaced horse-drawn carriages. The internal combustion engine displaced steam power. New species rise and old ones disappear. That is why Microsoft, Google, Amazon, and Meta cannot simply stop investing in AI. Technology companies are like the dancers in the red shoes. Once the shoes are on, they have to keep dancing. Innovation is their fate, and AI investment is a race they cannot walk away from. The moment they stop, the next technological era leaves them behind. Imagine the day Google loses search, Meta loses social media, or Microsoft loses its hold on the PC and productivity software. That is the day the countdown to irrelevance begins. For these companies, the issue is no longer whether more investment will strengthen their lead. It is whether they can survive if they stop. That is why I believe AI investment by the largest technology companies will not slow before the battle for the next major platform has been decided. It is more likely to accelerate. Corporate competition is only one source of demand. Competition between nations is just as powerful. Recent operations in Venezuela and Iran have shown governments what a technology gap can mean. When satellites, intelligence, communications, drones, algorithms, and precision strike capabilities are integrated into one system, the weaker side may lose far more than battlefield efficiency. Its command structure and even the security of the regime itself may be at risk. Public information does not tell us exactly how much AI contributed to those specific operations. But one point is already clear. In future geopolitical competition, computing power, models, data, and the ability to make independent decisions will all become foundational national capabilities. Just like energy, communications, and advanced manufacturing, Chinese companies face U.S. restrictions on exports of advanced GPUs. In my view, those restrictions will make China more determined to build its own computing capacity and software ecosystem, not less willing to compete in AI. Europe, Japan, South Korea, India, and the Middle East will not want to hand the future of computing and intelligent infrastructure entirely to other countries either. Companies are fighting to control the next user platform. Nations are fighting for long-term strategic survival. Even when some projects do not make economic sense in the short term, governments will not stop building AI capacity simply because the near-term return looks inadequate. None of this means every data center will make money, or that AI infrastructure can never become overbuilt. But over the next several years, three forces will still be operating at the same time: commercial returns, the struggle for the next user platform, and national security. I see no reason to expect companies and governments as a group to stop investing. The next question is where all of that demand will go. NVIDIA is certainly not the only company capable of providing AI compute. AMD has its Instinct accelerators. Google has TPU. Amazon has Trainium. Meta has MTIA. These are serious products. On the workloads for which they are designed, some may offer better performance or lower cost. TPU, Trainium, and MTIA are all custom ASICs designed for AI workloads, but they are used in different ways. Google has spent years building a complete TPU stack around its own models, compilers, and cloud platform. Trainium is Amazon's training and inference chip for AWS. External customers can use it, but they have to adopt the AWS Neuron software stack. MTIA is designed primarily for Meta's own recommendation, advertising, and generative AI workloads. It is closer to a specialized internal tool. Google and Anthropic can use TPU very effectively. Amazon can offer Trainium to customers through a WS Meta can direct stable internal workloads to MTIA. One thing ties all of those successes together. The chip, the software, and the workload have been adapted to one another over a long period of time. Broad outside adoption is a different matter. Existing models and engineering systems cannot simply move onto those platforms without substantial work. That is where GPUs retain an advantage. They are more general-purpose parallel processors. The same hardware can train new models, run inference, and be reprogrammed as models, operators, and software frameworks change. The faster AI evolves, the more valuable that flexibility becomes. Hyperscalers can move enormous, stable, well-understood internal workloads onto chips they design themselves. But rapidly evolving models, mission-critical projects that cannot be delayed, and the diverse needs of outside customers are much harder to move away from GPUs. In the general-purpose AI GPU market for external customers, AMD is NVIDIA's most direct competitor. AMD Instinct hardware is already very strong, and on some workloads it may even have an advantage. But a single GPU's specifications do not determine how much useful computing power an AI system ultimately delivers. The hard part is combining thousands, or even tens of thousands, of GPUs with networking and software, then keeping the entire cluster running reliably for long periods of time. With the GB200NVL72, NVIDIA pushed system-level integration to the rack scale, connecting 72 GPUs into a rack-scale supercomputer. Rubin keeps the same 72 GPU rack-scale design, but upgrades the GPU, CPU, memory, interconnect, networking, and software at the same time. The gains from a system-level upgrade can be extraordinary. Under the specific test conditions published by NVIDIA, Rubin needs only 1/4 as many GPUs as Blackwell to train a mixture of experts model. The cost per inference token can fall to as little as 1/10. To put that in perspective, a model that needs 4,000 Blackwell GPUs could, in theory, need only about 1,000 Rubin GPUs. If generating a given number of tokens cost $100 on Blackwell, it could cost as little as $10 on Rubin. NVIDIA's pace of iteration is also accelerating. Volta to Ampere took 3 years. Ampere to Hopper took roughly 22 months. Hopper to Blackwell took about 2 years. But from Blackwell in 2024 to Blackwell Ultra in 2025 to Rubin in 2026, NVIDIA has compressed the platform cycle to roughly 1 generation per year. A hardware upgrade that once arrived every 2 or 3 years is now arriving almost annually. A customer that receives a new system 1 year late may no longer be facing a 20% or 30% performance gap. The newer platform may train several times more efficiently and deliver inference at 1/10 the cost. Hardware performance sets the theoretical ceiling. What customers actually receive depends on whether the entire system can operate reliably over time. That brings us to CUDA. Many people describe CUDA as a software ecosystem. I do not think those 2 words come close to capturing its value. Think of AI development as cooking. CUDA is a fully equipped commercial kitchen. CUDA provides the core operations for deep learning. NCCL handles communication across large numbers of GPUs. TensorRT helps optimize inference. These tools are the stoves, ovens, knives, olive oil, and seasonings. Engineers can walk into this kitchen and start cooking immediately. AMD's kitchen may have a stove that is just as powerful, perhaps even more powerful in some cases. But the knives may need sharpening, the flour may have to be milled from grain, and if you want ketchup, you may have to grow the tomatoes first. TPU is different again. It is not an ordinary kitchen. It is a high-speed automated production line that Google built around its own models, software, and engineering workflows. The pans are square. The molds are star-shaped. The conveyor belt accepts ingredients only in prescribed sizes. Google can use this production line extremely efficiently, and Anthropic can devote substantial engineering resources to using it well. But an outside customer has to adapt its models, operators, data sharding, debugging tools, and production workflows to fit the line. That is a major engineering migration. Other kitchens can still produce a meal, but only companies like Google, or a small number of customers with enormous stable demand and deep engineering teams, can justify rebuilding the entire back of house around a specialized system. A typical company may finish rebuilding its kitchen only to discover that the market has already moved on. AMD GPUs and Google's TPUs will both win meaningful share. But in today's life or death AI race, launching an application a few months late can mean a weaker model, an inferior product, or even surrendering the next major user platform to a competitor. That is why customers are buying much more than a GPU. They are buying the computing power of the GPU itself. They are buying NVLink and networking that can organize tens of thousands of GPUs into one working system. They are buying CUDA, which allows engineers to begin productive work immediately. And they are buying the confidence that a multi-billion-dollar AI project can be completed on time. This also explains why Google already has TPU, Amazon already has Trainium, and Meta already uses MTIA, yet all 3 still buy large quantities of NVIDIA GPUs. They will gradually move stable, standardized internal workloads to their own chips. But they will continue to use NVIDIA for frontier workloads that evolve quickly and cannot tolerate delay. If even the hyperscalers still need NVIDIA, ordinary companies are even less capable of rebuilding a complete AI computing platform for themselves. ASIC projects make economic sense today partly because NVIDIA GPUs are expensive and difficult to obtain. Imagine a company with hundreds of thousands of employees, all eating the same fixed meal every day. If demand is large enough and the menu is stable enough, the company can build its own cafeteria, buy the equipment, and hire the staff. The upfront investment is high, but if people eat there every day, it may be cheaper over time than buying every meal from an outside restaurant. Google, Amazon and Meta are companies like that. They have enormous, stable AI workloads and the resources to maintain their own chips and software stacks for years. Most enterprises are different. Their demand is smaller. Today they need to train a model. Tomorrow they need inference. The day after that, the model architecture changes. Building a cafeteria, buying all the equipment, hiring the staff, and remodeling the kitchen every time the menu changes may not save money at all. As NVIDIA expands supply and drives down the cost of compute, it will not eliminate the hyperscalers ASICs. But it could squeeze out many smaller projects that lack sufficient scale, have unstable workloads, and were justified mainly because NVIDIA GPUs were too expensive and too scarce. As long as NVIDIA's product roadmap stays on track, and CUDA and the integrated platform are not materially displaced, demand is not the constraint. Production is. Each additional system NVIDIA can deliver becomes another sale. What NVIDIA can ship, it can sell. That leaves one question. Given TSMC's advanced node capacity, CoWoS packaging, HBM supply, and the rest of the complete system supply chain, how much more can NVIDIA actually ship? TSMC does not publish a table showing exactly how many NVIDIA accelerators its capacity can support this year, or how much that number can grow next year. Instead, it gives us several clues. At the beginning of 2025, TSMC said it expected AI accelerator revenue to double that year. It was also working to double CoWoS capacity. By January 2026, TSMC had raised its forecast for the compound annual growth rate of AI accelerator revenue from 2024 through 2029, moving it from the mid-40% range to the mid- to high 50% range. This was more than a forecast. In 2026, TSMC raised capital expenditure to between $52 billion and $56 billion and made clear that spending would be near the top of the range. To put $56 billion in perspective, 1 year of capital expenditure would exceed half of TSMC's total spending over the previous 3 years. The company also said its capital expenditure over the next 3 years would be significantly higher than during the previous 3. That money is turning into real capacity. TSMC has also shown that it can deliver. Its first Kumamoto fab began production by the end of 2024, just as promised. 3-nanometer production started on schedule at the end of 2022. 2-nanometer followed in the fourth quarter of 2025. And the first Arizona fab began 4-nanometer production in the fourth quarter of 2024. That record is why I believe most of the current expansion will arrive broadly on schedule. TSMC is also building more 3-nanometer capacity in Taiwan, with volume production planned for the first half of 2027. Its second Arizona fab is expected to begin 3-nanometer volume production in the second half of 2027. The second fab in Japan has been redesigned for 3-nanometer chips and is scheduled to enter production in 2028. At the same time, TSMC is converting some 5-nanometer equipment to 3-nanometer production, squeezing more output from its existing fabs. Advanced packaging is expanding as well. TSMC's additional $100 billion investment in the United States includes 3 wafer fabs and 2 advanced packaging facilities. As recently as April 2026, management was still saying that advanced packaging capacity remained extremely tight. TSMC would have to keep expanding with its assembly and testing partners. TSMC Chairman C.C. Wei put it bluntly, a new fab takes 2 or 3 years to build. There is no shortcut. Capacity is still extremely tight, and the company is doing everything it can to meet customer demand. TSMC's message is clear. Demand for AI chips is outrunning capacity. The company is expanding advanced processes, advanced packaging, and global manufacturing at the same time, and the pace of investment is still rising. Of course, TSMC's AI accelerator revenue includes more than NVIDIA. It also includes AMD, Google, Amazon, and other customers' ASICs. Growth in advanced node revenue also reflects migration to more expensive nodes and changes in pricing. So TSMC's mid to high 50% growth outlook cannot be treated as a direct forecast of NVIDIA GPU unit growth. New capacity will not be allocated evenly across every customer. NVIDIA has already committed real money to securing supply. At the end of fiscal 2026, Its manufacturing, supply, and capacity commitments totaled $95.2 billion. Not all of those commitments are with TSMC, but they show that NVIDIA is locking in future supply at enormous scale and over long time horizons. For TSMC, capacity built around a customer like NVIDIA carries less risk. NVIDIA has huge volume, a visible roadmap, and an immediate ability to absorb capacity. That improves utilization, accelerates yield learning, and strengthens economies of scale. AMD and the various ASIC programs will also receive more capacity, but their volumes and production schedules are less certain than NVIDIA's. My judgment is that NVIDIA will be the largest beneficiary of this expansion in advanced node and CoWoS capacity. I therefore use TSMC's mid to high 50% AI accelerator growth outlook as the closest observable anchor for NVIDIA's supply ceiling. Then I allow for ASIC share gains, HBM constraints, product transitions, Rubin's production ramp, and the challenges of delivering complete systems. After those adjustments, I use a rounded 50% annual growth rate as an approximation for NVIDIA's data center revenue over the next 3 years. In fiscal 2026, NVIDIA generated roughly $194 billion in data center revenue. Compounding $194 billion at 50% a year for 3 years produces approximately $654 billion. Rounded, that gives us about $650 billion in data center revenue in fiscal 2029. Outside the data center, NVIDIA also has gaming, professional visualization, automotive, and other businesses. I did not apply the same 50% growth rate to them. I assume only modest growth, bringing their combined revenue to roughly $30 billion 3 years from now. That produces total fiscal 2029 revenue of approximately $680 billion. I do not use a complicated net margin model either. In the first quarter of fiscal 2027, NVIDIA's adjusted net margin was approximately 55.8%. To allow for future price reductions, stronger competition, Rubin ramp costs, and the higher cost of complete systems, I round that margin down to 50%. A 50% adjusted net margin on $680 billion of revenue gives approximately $340 billion of adjusted core net income 3 years from now. Now we can move to valuation. In my valuation video, I explained how I estimate a reasonable price-to-earnings multiple. The PE is roughly the inverse of the long-term risk-free rate. I use a long-term risk-free rate of around 4% as the anchor, which implies a reasonable multiple of 25 times earnings. Multiply $340 billion by 25, and NVIDIA's core operating business would be worth approximately $8.5 trillion. But that is not the full value of NVIDIA. The $340 billion figure covers adjusted core net income only. It does not include interest on NVIDIA's net cash or returns on its public and private company investments. NVIDIA already holds approximately $110 billion to $120 billion in net cash and investment assets. It also continues to invest across AI models, cloud computing, robotics, autonomous driving, biotechnology, and other application layer companies. The potential value of those investments could be enormous. NVIDIA sits at the upstream end of the AI industry. It can identify earlier than a conventional investment firm which companies are actually consuming compute and which products are seeing real adoption. It can also provide portfolio companies with GPUs, CUDA, engineering support, and customer relationships. If an investment succeeds, NVIDIA can benefit twice. First, from appreciation in the value of its equity stake, and then from the portfolio company becoming a customer and expanding the reach of CUDA and NVIDIA's computing platform. This creates a reinforcing loop. NVIDIA uses the cash generated by today's AI boom to invest in the next generation of AI companies and help them build and scale their businesses on NVIDIA GPUs and CUDA. The more successful those companies become, the more compute they consume. That demand flows back into NVIDIA's core business and strengthens its ecosystem. In other words, NVIDIA is using the profits from this AI revolution to buy tickets to the next one. There is no reliable way to estimate how large those companies may eventually become. So I do not try to price speculative unicorn upside. I count only the net cash and investment assets visible today, plus the amount NVIDIA can reasonably accumulate by the end of fiscal 2029, using the same revenue growth and margin assumptions, and excluding the portion already earned in the first quarter of fiscal 2027. NVIDIA could generate close to $690 billion in additional adjusted core net income between now and the end of fiscal 2029. Not all of that profit will become net cash or investment assets. NVIDIA will continue to repurchase shares, pay dividends, acquire companies, and invest in R&D infrastructure. Some of the cash will also be converted into new AI equity investments and remain on the balance sheet as investment assets. After accounting for those uses of capital, I estimate that NVIDIA could hold approximately $300 billion of net cash and investment assets by the end of fiscal 2029. This estimate already leaves substantial room for large buybacks, dividends, acquisitions, and long-term strategic investment. I still assign no value to extraordinary gains that the investment portfolio might produce. If some of those investments appreciate dramatically, they would become a second growth engine on top of the core business. Add $300 billion of net cash and investment assets to the core business value of $8.5 trillion. That gives us a fair value for NVIDIA 3 years from now of approximately $8.8 trillion. At a current market capitalization of $5 trillion, that implies an annualized return of roughly 20% over the next 3 years. I still find that highly attractive. So my conclusion is clear: I will continue to hold NVIDIA. As long as the fundamentals remain intact, a pullback would be an opportunity to add. I would consider selling under either of two conditions. The first is if NVIDIA's PE approaches 50 times earnings. The second is if its current market capitalization reaches roughly 1.5 times my then current estimate of fair value 3 years out. Price matters. Fundamentals matter more. Research on a company as large as NVIDIA can never be complete. My job as an investor does not end when I write down an $8.8 trillion number. It is to keep testing the assumptions behind that number and decide whether they are still true. Has CUDA or NVIDIA's full computing platform been genuinely displaced? Can each new product generation maintain the company's lead? Can the market absorb all of the additional capacity? Has gross margin fallen sharply for reasons that cannot be explained by temporary factors? These are the questions that will determine NVIDIA's long-term value. I will continue to track the data and share an update whenever the evidence changes my view.